In 2020, something kind of insane happened. Houses weren't just selling fast, they were disappearing. 48 hours, sometimes less. People weren't negotiating, they were panicking, waiving inspections, removing every condition, throwing in offers tens of thousands over asking like it didn't matter. Some buyers didn't even step inside the house, they just bought it. Now pause for a second, because today, that same market feels completely different. Homes are sitting, sellers are cutting prices, buyers are negotiating again, which not that long ago felt impossible. So what changed? And here's the real question. Did the market break? Or is this just what normal actually looks like after everything we just went through? Because depending on that answer, you either need to move fast right now, or you need to be very, very patient. My name is Daniel, and I spend way too much time thinking about money psychology, especially those moments where reality doesn't match the numbers. And right now, the housing market is one of the clearest examples of that disconnect I've seen in a long time. Because if you just look at the data, nothing looks that bad. Prices are still near all-time highs across most of the country. But if you actually feel the market, it feels stuck, frozen, like something underneath isn't working. Fewer people are buying, builders are getting nervous, mortgage applications have dropped off hard. So how can prices stay high while everything else quietly slows down? That's the part nobody explains properly. So let's actually walk through what happened, step by step, because once you see it clearly, the current market starts to make a lot more sense. Go back to 2020. Rates dropped to basically zero. The government started injecting money into the system, and almost overnight, people realized they didn't have to live near their job anymore. So naturally, they started moving. They upgraded their homes, left expensive cities, bought in places they had never considered before. And the key detail here, money was cheap, really cheap. Mortgage rates dropped into the 2% range, around 2.6%, 2.8% for a 30-year loan. And when borrowing money gets that cheap, something subtle but powerful happens. People stop thinking about price and start thinking about monthly payment. And when the payment feels manageable, they stretch. A little more house, a slightly better neighborhood, a decision that feels small in the moment but compounds across millions of buyers. So demand didn't just increase, it surged. But here's where the imbalance started. Supply didn't move. You can't just create houses overnight. Materials got expensive, labor was tight, regulations didn't change, and most importantly, people who already owned homes locked in those ultra-low rates. So why would they sell? They wouldn't. So now you had this situation where millions of buyers were competing for a very limited number of homes. And that's when the market lost control. Bidding wars became normal. Cash offers started dominating. People were buying homes from different states without even seeing them. And prices responded exactly how you'd expect. From 2020 to early 2022, home prices jumped over 40%. 40% in 2 years. That's not growth, that's pressure building. And pressure like that doesn't just stabilize on its own. Then everything flipped. Inflation started creeping up, and then it didn't stop. By 2022, it became a serious problem. So the Fed stepped in, and this time they moved fast. Rates didn't slowly rise, they jumped. From near zero to over 5% in about a year and a half. And mortgage rates followed right behind. That 3% loan everyone got used to? Gone. Now you're looking at 7%, sometimes higher. And this is where people underestimate the impact, because it's not just rates went up. It's what that actually does to real life. Take a $400,000 house. At 3%, your payment is roughly $1,300 a month. At 7%, that same house jumps to over $2,100. That's almost an extra $800 every month for the exact same house. That's not a small adjustment, that's a lifestyle shift. So buyers did the only logical thing. They stepped back. Demand didn't slowly cool, it dropped. Applications fell, sales slowed, The energy just disappeared. But here's where this market became different from anything we've seen before. Sellers didn't panic, and this is the key to everything. In most downturns, when buyers disappear, sellers lower prices because they have to. But this time, most homeowners are sitting on 2 to 3% mortgages. So ask yourself this: why would someone sell their house, give up a 2.9% loan just to go buy another house at 7%? They wouldn't. So instead of prices collapsing, supply just stayed locked. And this created something weird. Homeowners are locked in, buyers are locked out, and the market just stops moving. Not crashing, not growing, just stuck. And this is why the market feels broken. Because technically prices haven't fallen much, but at the same time, people can't afford to buy. So you end up with this strange situation where the numbers say one thing and real life feels completely different. And right now, affordability is one of the worst we've seen in decades. In many places, buying a home takes a bigger portion of income than it did in the late 1980s. And in some cities, it's the worst it's ever been. Now think about who this affects the most. Millennials, the largest generation who were already late to buying homes because of student debt, the 2008 crash, rising rent. They finally started entering the market around 2019 to 2021, and then the window closed. Not because they failed, not because they made bad decisions, but because the math stopped working. And that changes something deeper than just finances. Because homeownership isn't just about money. It's tied to stability, progress, the idea that you're moving forward. So when that suddenly feels out of reach, it changes how people think about their future, their goals, even their country. That's the psychological side of this that most people ignore. So where are we now? Look, the market isn't one thing anymore. Some areas are already correcting. Places like Austin, Phoenix, Boise, where prices went crazy, have come down. Other markets, especially ones with limited supply, are still holding strong. So there isn't one clear answer, but there are a few things happening right now that matter. Inventory is slowly rising, not a lot, but enough to notice. Buyers are gaining a little more power. Builders are stepping in with incentives, helping people get slightly better rates. And everyone is watching interest rates because that's the unlock. If rates drop meaningfully, buyers come back. But when buyers come back, probably sellers do too. And that's the balance the market is waiting for. So should you actually do? Here's the honest answer. Nobody knows exactly where this goes next. Not me, not analysts, not anyone on YouTube. But you don't need to predict the entire market. You just need to understand your position inside it. If you're buying, ignore the headlines and focus on your numbers. Can you afford the payment right now comfortably? Not based on hope, not based on future rate cuts, right now. If yes, and you're staying long-term, then buying can make sense. If not, forcing it will hurt you more than waiting ever will. If you're selling, just think one step ahead. Where are you going next? Because the gain you make selling might disappear the moment you buy again at a higher rate. And if you're renting, don't feel like you missed something. This isn't a normal market. Use this time to get stronger financially, because waiting isn't losing if you're preparing. At the end of the day, this market comes down to something simple. The numbers say one thing, reality feels something else. And until those two reconnect, this weird frozen feeling stays. So instead of trying to guess whether it crashes or takes off again, focus on understanding it. Because right now, understanding is more valuable than timing. And honestly, that's where most people get it wrong.